Well, ladies and gentlemen, welcome back to Boss Economics World, the only place where we take the hot mess of global finance, sprinkle it with some spicy data, and serve it up with a side of satire so sharp it could cut through a corporate bond yield curve. I'm your host, the Boss Economist, here to break down the latest economic circus act that's got Wall Street buzzing, Main Street scratching their heads, and your grandma wondering if her pension fund is safe. Buckle up, folks, because today we're diving headfirst into the corporate bond bonanza of 2025, a tale of FOMO, Fed flip-flops, and a market so frothy it makes a Starbucks latte look flat. Alright, let's set the stage. It's August 15, 2025, and the US corporate bond market is hotter than a TikTok dance trend. According to Bloomberg Index data, the extra yield, or spread, that investors get for holding investment-grade corporate bonds over treasuries has shriveled to a measly 73 basis points. That's the lowest since 1998, folks. For the non-finance nerds in the room, that means corporate bonds are now so expensive, they're basically the Birkin bags of the fixed income world. Investors are tripping over themselves to lock in yields that are still hovering above 5%, all because they're betting the Federal Reserve is about to hit the rate cut button faster than you can say, quantitative easing. But wait, there's more. This isn't just about some suits on Wall Street chasing yields. Oh no, this is a full-blown economic soap opera, complete with drama, intrigue, and a cast of characters that includes the Fed, Donald Trump's tariffs, and a slowing economy that's wheezing harder than a chain smoker running a marathon. So, grab your popcorn, or your portfolio statements, and let's unpack the economic madness behind this corporate bond bubble, from the surface-level shenanigans to the deep, dark underbelly of risk complacency. Because here at Boss Economics World, we don't just report the news, we roast it. Let's start with the obvious, shall we? Investors are acting like it's Black Friday at the bond market, and the Fed is handing out rate cuts like free samples at Costco. Why the frenzy? Well, after years of the Fed jacking up rates to fight post-pandemic inflation, pushing average high-grade bond yields above 5%, the market is now convinced that Jerome Powell and his merry band of central bankers are about to pivot. Recent economic data shows inflation is cooling, the labor market is softening, and everyone's betting on a September 2025 rate cut. And when the Fed cuts rates, bond prices go up, yields go down, and investors who locked in those juicy 5% yields are sitting pretty. But here's the kicker, some of these investors are the same folks who got absolutely torched during the 2022 bond market rout, when the Fed's aggressive rate hike sent bond prices into a tailspin. Remember that? Yields spiked, prices tanked, and pension funds were crying into their spreadsheets. Now, those same investors are back, driven by what Matt Brill at Invesco calls, wait for it, FOMO. That's right, folks, the fear of missing out isn't just for crypto bros and NFT flippers anymore. It's now the guiding principle of multi-trillion-dollar asset managers. Brill, who oversees $2 trillion in assets, says, these are yields people wanted for years. Translation, we're scared the party's ending, so we're jumping in headfirst. And the data backs this up. According to JP Chase, funds investing in investment-grade bonds are seeing record-setting inflows. Their strategists, led by Eric Bienstein and Nathaniel Rosenbaum, noted on August 12, 2025, that inflows surge when the Fed cuts rates and dry up when it hikes them. Shocker, right? But here's the juicy part, they're predicting a period of strong fund inflows because the market has already priced in rate cuts for the next 3 Fed meetings in 2025. In other words, the bond market is basically a giant casino, and everyone's betting on the Fed to keep the champagne flowing. Now, let's talk about the other side of this equation, supply, or the lack thereof. You see, while investors are throwing money at corporate bonds like confetti at a wedding, companies are playing hard to get. Why? Because they're betting rates will drop, so why borrow now when they can borrow cheaper later? JP Morgan expects a third consecutive month of negative net supply in August 2025, after accounting for $71 billion in maturities and $35 billion in coupon payments. That means there are fewer new bonds hitting the market, which is driving up demand for the ones already out there. And it gets better, or worse, depending on your perspective. Mark Clegg, a senior fixed income trader at Allspring Global Investments, says dealers are literally running out of bonds to sell. His exact words: finding clever trades is harder than finding a parking spot at Costco on a Saturday morning. Oh, Mark, you sweet summer child, welcome to the corporate bond Hunger Games, where the odds are never in your favor. But here's where it gets really spicy. This supply-demand imbalance isn't just a quirky market quirk, it's a symptom of a deeper economic problem. Companies are holding off on borrowing because they're worried about the economy slowing down. And why is the economy slowing down? Oh, I don't know, maybe it has something to do with a certain former president's tariff tantrums. That's right, folks, Donald Trump's trade war is back, and it's hitting the economy like a wrecking ball. According to the U.S. Chamber of Commerce, tariffs imposed in 2025 have already cost American businesses $125 billion in additional expenses, with ripple effects on supply chains, consumer prices, and corporate profits. So, while investors are chasing yields, companies are battening down the hatches, waiting to see if the economy implodes or if the Fed rides in on a white horse to save the day. But now, ladies and gentlemen, it's time to peel back the curtain and reveal the real villain of this story: risk complacency. You see, while everyone's busy chasing yields and betting on Fed rate cuts, they're conveniently ignoring the fact that these corporate bonds are getting riskier by the day. With spreads at 73 basis points, the lowest in nearly 3 decades, investors are basically saying, what could go wrong? Spoiler alert, a lot. Let's break this down. Narrow spreads mean investors aren't getting paid much extra to take on the risk of owning corporate bonds instead of ultra-safe treasuries. And what risks are we talking about? Oh, just little things like a slowing economy, a weakening labor market, and the ever-present threat of corporate defaults. Bloomberg intelligence analyst Noel Hebert pointed out that spreads peaked at 119 basis points in April 2025, after Trump's tariff threat sent shockwaves through the market. He expected spreads to settle around 93 basis points, still a far cry from today's 73. His take: some decent portion of that difference is complacency around risk pricing. Translation: investors are drunk on yields and ignoring the hangover that's coming. And the data backs this up. According to S&P Global, the U.S. corporate default rate has been creeping up in 2025, hitting 4.2% in July, the highest since the post-pandemic recovery. Meanwhile, the Conference Board's leading economic index has been declining for 6 straight months, signaling a potential recession on the horizon. And let's not forget the labor market. Unemployment ticked up to 4.8% in July 2025, the highest in 2 years, according to the Bureau of Labor Statistics. So, while investors are popping champagne over their bond yields, the economy is flashing warning signs brighter than a Las Vegas casino. But wait, there's more. UBS Group strategists, including Matthew Mish, are sounding the alarm, saying there's very little risk priced in to these tight spreads. They expect spreads to widen as the labor market weakens, the Fed cuts rates, and yields decline. And here's the kicker: even if yields drop, bond prices will go up, so investors might not care about the risk. It's like buying a house on a fault line because the view is nice. Sure, it's pretty now, but what happens when the ground starts shaking? So, what's the takeaway, folks? For the ordinary folks watching at home, this corporate bond bubble is a stark reminder that Wall Street's greed can sometimes blind it to Main Street struggles. If the economy slows further, or, heaven forbid, slips into recession, those juicy bond yields could turn into a bloodbath of defaults, leaving pension funds, insurance companies, and everyday investors holding the bag. And for the finance pros in the audience, it's time to ask yourself, are you chasing yields, or are you chasing trouble? And let's not forget the Federal. Oh, Jerome Powell, you sly fox, you've got the market eating out of your hand. But here's the thing: rate cuts might boost bond prices in the short term, but they won't fix the underlying problems of a slowing economy, geopolitical uncertainty, and a corporate sector that's leveraged to the hilt. According to the Institute of International Finance, global corporate debt hit a record $92 trillion in Q2 2025, up 5% from the previous year. That's a ticking time bomb, folks, and tight spreads are like putting a band-aid on a broken leg. So, there you have it, folks, the corporate bond market of 2025, where FOMO meets Fed fever, supply meets scarcity, and risk meets recklessness. Tune in next time to Boss Economics World, where we'll be roasting the latest economic absurdity. Maybe it'll be crypto, maybe it'll be ESG, or maybe it'll be another round of tariff tantrums. Until then, keep your wallets close, your skepticism closer, and remember, in the world of finance, the only thing riskier than taking a risk is pretending there isn't one.